Hello and welcome to the quarterly context webinar for the first quarter of 2019 for clients of the advisory group. This meeting is designed to help clients receive high-level perspective regarding top-level planning elements, the economy, markets, investor behavior patterns, and so forth in order to help both our personal wealth and institutional clients better achieve their goals. We try to keep these meetings to about 20 minutes, and we'll circulate a video link as well, should you like to view some portion of it again or pass it on to someone that you think we can help like we've helped you. If you have any questions, please submit them to the question box, and we'll either answer them as we go along or at the end of the presentation. So thank you for being here. As our constant reminder, it's valuable to keep the top level focus on things that you can control and things that matter. And so to the extent that any elements of your short-term, long-term, desired or required elements of your goals shift, please contact your advisor here at the advisory group to help potentially adjust your plan and structure accordingly. If we take a peek at the markets to start, or at least the news in the markets, we can see that there are always going to be news elements, and this last quarter was interesting for a few different reasons, whether it had to do with projected trade talk dates and the Fed backing off of rate hike forecasts or other elements. News items can always bump the market around a little bit, but any given quarter really is small in the longer term perspective. There's a chart for that here, and if you were to look at this over a longer time period, a lot of these small bumps are not even noticeable. Looking more specifically at markets for the last quarter in the year, it was a surprisingly strong quarter with stock market returns in the 10 to 14% range. So some of the strongest quarterly returns in a long time, with the year numbers positive for the U.S., still a little bit weak for international given some struggles there, and that's because in part of the strong dollar and the currency effect there in the short run. But overall, what's most notable is how difficult the fourth quarter was, and how much of that was, or since all of that was essentially brought back and recovered in the first quarter. So as if that fourth quarter weak market never happened. One notable element as well that we've been talking about is the yield curve. This shows the charting of the treasury yields across the maturity spectrum for different points in time. The gray line here was the end of early 2017. This blue line was at the end of last year, and you see what's called a little bit of a inversion at the front end of the curve. And now the curve at the end of March shows a more notable inversion, where the longer term rates going out to around the 10-year mark are actually lower than the short-term yields. So this is, we'll talk about more about this in a minute, but that oftentimes precedes a recessionary environment. The problem is that the recessions that follow are oftentimes somewhere between 6 months and 4 years out. So that doesn't mean anything is necessarily imminent. Taking a peek at a couple of things that drove the markets, part of what pushed up stock markets was the Fed signaling that they would not be raising rates. And in fact, the market futures is suggesting that there might be a cut, given some of the concerns on the horizon. But that pause in the Fed helped really fuel a kind of a risk-on market after that risk-off market of the fourth quarter. And that fourth quarter number, or as difficult stock markets turn out to be, in retrospect and upon further analysis, exacerbated by poor liquidity, especially in some of the bond segments, where there just were a shortage of buyers, and that really pushed prices down. The international markets are still a little even more uncertainty than in the U.S., given Brexit questions, Italy's recession, U.S. policies, and so forth. And there's a question about China with some slowing there, but had a very strong first quarter given the market's excitement about the Chinese government's stimulation of the economy through financial mechanisms. So let's take a peek then at this yield curve inversion question. We mentioned that it's oftentimes followed by a recession. Here you can see charts that show the blue lines are the rate hiking cycle, which tends to dampen equity markets, and the yield curve spread as well. And you can see that the red dot is where an inversion happened without a recession. There are two cases here, but in the other 6 or 7 cases here, and also common going farther back in history, is a recession, a recessionary period of some time. And here we can see the length of time to the recession. So essentially from between less than a year to approaching 2 years, but sometimes it takes longer than that. Looking at some of the economic snapshots here, in terms of some of the metrics, fourth quarter growth in GDP was revised down to 2.2% due to softer consumer spending and some other factors. And many are expecting that growth may continue to soften a bit, but not fully stall the economy, at least in the short run for 2019. And the Fed is expecting an overall growth rate in 2019 of 2.1%. China, by contrast, has about 3+ times that growth rate, but that represents a slowdown for them, actually a 28-year low. But we'll see where that goes with the Chinese government stimulation mentioned before. I talked about how rates are unchanged. The Fed has also signaled that it'll be slowing the tapering of the $4 trillion asset portfolio that was part of the post-global financial crisis stimulation package. So that slowing that tapering essentially increases stimulation a bit. Inflation, interestingly, took a dip in February down to 1.5% year over year with in terms of headline CPI, whereas excluding food and energy, it was closer to 2.1%. That 1.5% was really heavily impacted by energy being down about 5% for the quarter. Unemployment remains low, still hovering around this level, 3.8 or so, and just above the low of 3.7% last fall, and still around a 50-year low for unemployment numbers, and the 100th straight month of gains, which is the longest ever experienced by the recorded economy. Wage growth pared back slightly, but from the number that had been the strongest number in a while, but that's still at 3.2, down from 3.4, which is still below the 50-year average of 4%. And on an inflation-adjusted basis, workers aren't making as much ground as a result, and that can affect consumer confidence as well as spending, and that may be part of why the economy is moving forward, not too hot, not too cold, but and some other numbers we've seen suggest that part of the reason that some of those wage gains are actually in the upper end of the spectrum rather than the broader populace, and that has interesting implications. We'll look at consumer confidence in a moment. So let's keep moving through here. If we look at the business cycles, this is an overly smooth and simplified chart, but it gives a rough approximation of where a few major economies sit currently. So China, Japan, and Brazil in recovery mode. Italy, France, US, India, and Germany in sort of post-peak expansion, but that tends to eventually shift towards a little bit of a cooling and eventually to a contraction. And the UK seems to be the closest to a contraction at this stage. So based on this chart, if you see where we are and what this implies in terms of somewhere between mid and late stage cycle of growth tapering off, rates potentially rising or have risen, and so forth, that tends to lead to some gradual cooling in combination with other factors. In terms of the economy over time, we've talked a little bit about unemployment, still hovering down around that historical low level, wage growth coming up, but now starting to hover a bit. Inflation staying relatively tame. Consumer confidence dipped as part of that fourth quarter and then had a spike back up because of the first quarter. So that's a pretty sizable swing there. And as a reminder that confidence can be affected by the market and not just people's jobs and 401k accounts, but rather their broader sense of a combination of all of those things that might affect what's sometimes called the wealth effect of how they're feeling, and people are feeling in aggregate about their wealth and what that implies about how they feel moving forward. Oil picked up a little bit, and you can see the projected earnings here continue to be relatively strong, but that can always take a shift if economic factors become more uncertain. In terms of valuations, we can see that the current S&P valuation based on the PE ratio hovers right around the 25-year average, given the market dip and jump back up in the first quarter. You can see valuations across multiple markets tend to be hovering around the averages as well. So hard to say that they are significantly undervalued or overvalued at this stage. You can see that dollar movement and the recent uptick here, which affected the international holdings of those that hold international funds, and volatility overall had a kind of a spike and now has come back down a little bit. This is a chart we always show, the four bad bears. The blue line is the global financial crisis. The red is the 70s oil and financial crisis. The green is the dot-com crash and recovery. And the gray line is the Great Depression, all with the same starting point. And this is shown on an inflation-adjusted basis, whereas the bottom chart is before inflation. So the top chart really shows what the sort of real effect is on people's accounts and savings. And we'll just note here, you can see the dramatic nature of that fourth quarter and the subsequent rebound. And we'll also point out that this in March, we hit the 10-year anniversary of the bottom of the global financial crisis market here, shown in blue. So happy birthday. Something we produce yearly is the periodic table of returns. This is an interesting view in one page of different markets over time. Top return, highest return at the top, worst return at the bottom, and then year by year over time for an array of asset classes. And the big message here is there are no clear and persistent patterns that you can rely on if someone is trying to time the markets. So ultimately, the conclusion is that this is a great case for diversification, where if you blend all of the asset classes together appropriately, you will always get some of the top returns without getting too much exposure to the bottom return. So, and what some people will find is they think they've identified a pattern. Look at, for example, international stocks just seem to be gradually ratcheting up for a while and then had a cooling period and then ratchet up for a while. So be careful about getting too excited about short-term things that seem to be short-term patterns. Again, high yield is another one, seem to be hovering low. Just looking at this, you think, well, that's not interesting, and then several years of strong returns. Looking at returns historically as well, this is another chart we tend to look at yearly. This is a histogram showing the last couple hundred years almost of returns in a chart showing different return buckets. So 0% to -10, -10 to -20, and 10% increments on the right-hand side. And you can see that the bulk of returns happen on the positive side of this curve, with occasional negative returns that hover in the -10%, 0 to 10%, -10% range. And then in reality, over this long a time period, not that many returns that are worse than -10%. And of course, the global financial crisis fell in that bucket of being one of the worst 5 ever. Sometimes this is helpful when trying to remember what the long-term patterns are and how they literally stack up. One thing that's notable is that the 10-year return for the S&P 500 is 13%. That is highly unusual and higher than average, and about 3 or 4% higher than the projected returns over the next 10 years on average. So be careful about your expectations, and because these strong returns we've had in a number of the last 10 years are not likely to repeat themselves in the same way moving forward, at least in the near or medium term. Looking at behavioral patterns of investors, some of the industry aggregate mutual fund data shows mutual fund cash flows, and what you can see here is year by year inflows and outflows by very broad asset class types. So you can see not much in the way of inflows for U.S. equity. Probably people got concerned after the fourth quarter and then pushed a bunch of money into taxable bonds and cash, only to miss that really strong first quarter. So that's a sad case of locking in their losses, most likely. So oftentimes this can be a helpful chart to remind yourself what not to do. The average investor is chasing returns rather than being a disciplined investor over time. Another chart on that, somewhat on that note, there was a study that showed, for those of you who are familiar with target date funds that are becoming more common in 401k plans, where the asset allocation is automatically shifted over time, not custom to each person's individual case, but it is nonetheless a helpful approach for many, given that the average investor may not create an appropriate asset allocation for themselves in a 401k plan at any given point in time, and may not adjust it appropriately over time. And you can see that the pattern of return relative to risk is a fairly predictable curve ultimately based on age. So it's a kind of a pattern of increasing stock exposure or decreasing stock exposure, conversely, in that risk return space. For those that are do-it-yourself participants, it's all over the place compared to those more predictable target date fund or pre-built portfolio investors. So here you can see this gray line approximates the same element of this chart on the left superimposed, and the ultimate message here is that returns are quite a bit different when people are doing it from scratch on their own. You can see there is a somewhat small group of people who have done a little bit better in terms of return, and some have done a little better with similar return with a little bit less risk, but the majority of people seem to be under this more efficient approach of pre-built portfolios and target date funds. And a lot of people who are having dramatically lower returns, in a lot of cases with more risk, or dramatically more risk for the same level of return. What's also notable is that these red dots, of which there are many in this group here, are the people who are 55 and over, and are probably, in the case down here, overly conservative, and in this case, in this broader group here, overly aggressive. So using a more disciplined approach on a personal wealth basis like we do with our clients, or in 401k plans through appropriate structures, can help avoid those problems. You may have seen on our blog this quarter that we have a piece about something called the happiness equation. Won't go into too much depth here. You'll enjoy reading the blog post in full. But the basic idea is that and reducing the longer equation into the most simplest form is that by having your expectations in check and having your perception, therefore, of what really happens exceed your expectations, that leads to higher levels of happiness. This relates to all parts of life, as you can imagine, and is also critical in terms of investment decision management, in terms of ongoing discipline and satisfaction. So take a look at that blog post. I think you'll enjoy it. The quality thermometer for the quarter, you can see, whereas last quarter was a lot of green, which meant that higher quality stocks were outperforming, and higher quality stocks tend to be those that have stronger balance sheets, stronger financials, less debt, less risky, less volatile. But this was more of a risk-on quarter, where the more aggressive, more speculative stocks, prices jumped up, in great part due to the Fed backing off on or signaling patience with rate increases. So you can see that went from having the A plus stocks be at the top on this periodic table, quality periodic table, to the worst rated stocks knocking it out of the park, whereas they were at the bottom just a couple quarters ago. Tends to go back and forth over time, but the last 10 years for the most part has favored lower quality, and it's not unreasonable to expect that higher quality will benefit as the economy cools a bit. We try to build both higher quality and lower quality into the portfolio as an additional diversification layer. For the asset class corner this quarter, give you a snapshot of the projected returns now that the capital market projections have come out. And we can talk to you each more about this individually, but the summary is that the 10-year geometric returns are shown here versus the 10-year geometric returns from the prior year's 10-year projection here. And overall, the stock market projections are up about 0.3%. Bonds are up a little more than that. And ultimately, what that suggests is that it may make sense, all things equal, to stay the course given the needs, or if you have are borderline in terms of your projected needs, that you may be able to achieve the same goal with slightly less risk. But that's something that's very specific to each client, and that's over. This is again looking out over 10 years. A lot of our planning for clients looks out much farther than that, and so this may not suggest a specific portfolio change at all, but it informs the discussion and the recommendations, and helps us model portfolios and evaluate risk as part of that overall process by our internal investment committee. Taking a look at those numbers and how they've projected over time, going back about 30 years, you can see how the projected returns have gradually come down for some time. There are a number of reasons for that, including less innovative and less groundbreaking innovations in productivity is probably the broadest answer to that. And now returns have ticked up, projected returns have ticked up a little bit, but we would expect them to probably hover in that range. And until whether it's AI or some other major productivity enhancing element really takes hold, equity market returns may remain a little more dampened relative to long-term history. In terms of the rules and regs corner, this is now we're in the first tax season under the new tax rules, so I'm sure you've had conversations with your accountant, potentially with your advisor here if you're on the personal wealth side. In terms of regulations, there's continued deregulatory behavior. there were a number of items that occurred in the last year or two. In addition to that, there's essentially reduced scrutiny of big banks in the U.S. and asset managers and insurance companies, essentially removing the pass-fail grades in the stress test system, and that could increase risk-taking at those financial entities. So the reason we bring this up here is because it helps awareness that if there's potential increase in volatility, then it makes it even more important to temper your expectations about the ups and downs of the market. For fiduciaries, a few elements here that came out from the IRS. So you can take a peek at that and then check in with us if that's relevant for you. There was also a class action lawsuit that is an interesting case study where participants were claiming improper fees without disclosure. And so that's something that fiduciaries of 401k and other retirement plans need to be aware of. And we certainly help our clients try to ensure that they are having controlled cost, low cost, and highly disclosed elements consistent with all of the regulations so that the clients don't encounter that type of problem. WellStep, our online tool, continues to be in development. We're hoping to launch that still in 2019. And the blog, if you are a fiduciary and have plan participants that are nervous about volatility or looking for tips and some general guidance, the blog is already live and public and can be helpful. So take a peek there, and you may find blog posts that you might want to circulate to plan participants. And we have sent out communications about that before as well, but that's always a good place to take a peek. In terms of a general catch-all other, I won't go into too much detail, but because this affects how investments are evaluated, MSCI, which is an index house, is increasing the exposure to China in its benchmark, so that changes things a little bit in terms of index construction and how index funds will implement that. And Saudi Arabia, similarly, was added to some indexes, and they are one of the largest emerging market countries, and so that also helps reshape sort of what the investable and measured markets are. One almost last item for today is that we've had a couple of our foundation endowment clients recently asked us for talking points about how they, what might be helpful for them to share with donors about their process to help instill a deeper level of confidence in potential significant donors that want to donate money into the foundation or endowment to help further the mission, the cause of their community. And so here are a few items that may be helpful as a little summary for your pocket. That one of the things that you are doing, if you're a fiduciary in that capacity, and supporting your mission, is it's really about using a process, using experts, using resources similar to what the multi-billion-dollar foundation and endowments are doing through the advisory group and our access to Callan, using a sustainable spending policy approach, which not a lot of organizations do, so that helps promote the longevity of the fund and the impact. An investment structure that's consistent with that spending policy, capital market projections as part of that planning process, careful manager selection and due diligence, no conflicts of interest, cost controls, ongoing fiduciary education, and so forth. So our clients that have communicated this have found it's in some cases very helpful for donors who are trying to decide where to donate their money to help their communities. So on that, I want to thank you for joining us today. We hope you feel well supported by the advisory group, and whether you're a personal wealth client or a fiduciary client or another advisor type, such as accountant or attorney to our clients, that we're oftentimes helpful to as well. And we always welcome feedback about how we could serve you better, and we are also always appreciative of your spreading the word about the advisory group in case you know organizations or people that we can help like we've helped you. So thank you again for attending, And we'll go now in a moment to see if there are questions. Looks like there are no questions specifically at this time. And with that, I think we will end the webinar. If you were just about to type that in or have a question, of course, feel free to email or call us, and we look forward to talking with you. All the best, and take care.